Welcome to the Trader Merlin Show with your host, Merlin Rothfeld.
Hello everybody, welcome to Trader Merlin. As you can see, we've got a new set, new style, and this might be changing rather regularly on the program. I'm actually going to do something a little bit different today. I'm going to try to go through our top 7 markets as quickly as possible just because we got a great guest lined up for today. So let me tell you what the program is. For those of you who would like to fast forward through some of the program, opening portion, probably the first couple minutes, will be a market overview, just kind of see what happened out there. Then we'll do a trader profile of a good friend of mine from the trading floors back in the day in the 90s. Wendell will be joining us and also going over a bunch of market analysis. So basically 3 big segments. Of course, we'll be taking your listener questions as they come in, so feel free to send those on in. We're broadcasting live on YouTube. That's going to be under Trader Merlin, so check it out there. Join in the discussion, be friendly, and send in questions and comments as well as at TraderMerlin.com. Okay, let's start things off. Another crazy day, and as who's the gentleman that said it? Pepper Bradford on our YouTube channel says, reminds me of Mr. Miyagi saying, risk on, risk off, risk on, risk off. Yeah, it's, I think it was another song that goes, kick them when they're up, kick them when they're down, kick them when they're up. And that's pretty much what our markets have been doing. Let's start off with our worst performer. And as I said, I will be going through this quicker than normal just so we don't spend too much time in keeping our guest on hold. We'll do the market update. Let's start things off, as TJ says, with the Russell 2000. You guys can see here on the daily of the Russell 2000, it's been pretty ugly. We had a very big down day yet again today, 6.41% for the Russell to the south side, finishing at 1264. Yes, we're up 2 points in the after-hour session, but who cares? You're still down a ton, down 86 points on the Russell 2000. I also have some purple lines drawn on your screen. The reason for this is I'm sick and tired of everybody saying we're in a bear market. Remember we said yesterday it's 20% off of the high. Well, we were in a bear market on the Russell 2000 as of Monday. Basically, that would be 1372, which is, I should be lower than that, TJ. It should be in the middle of this red candle. 1372 is where that 20% mark would be for the Russell 2000. So as you can see, as of 3 days ago, we were on Monday. That's when we broke into a bear market for the Russell. But that, to me, is not the market. Number 6 is the S&P 500. Here is your ES futures. Now, you'll notice that I also have that purple line down here at the bottom. We were in bearish territory for a little bit. We had 3 breaks below it for the last 3 days, Monday, Tuesday, Wednesday. We did break below that line. That line in the sand for me, as I mentioned on yesterday's show, was 27.17. We have not closed below that number, so I'm not too concerned about it yet. Now, the numbers for the day for the S&P, down 4.89%. 2741 is where it closed out. An ugly day out there. Who knows? The way we've hit these numbers, it wouldn't surprise me to see a nice green day tomorrow. I know it seems inconceivable, but hey, that seems to be the risk on, risk off type of move. All right, NASDAQ 100, also with the purple line on your screen, which would denote the 20% decline on the NQ futures from its all-time high. That would be 7,810. We reached a low today and on Monday, or yesterday and on Monday, of 7814. So we're not even crossing over that on the NASDAQ yet, but that is in fact your 20% drawdown, that purple line on your screen there. NASDAQ, 4.7% drop. That was 392 points, man, down to 7,900 and change. Pretty big drop. All right, well, that's for the composite, excuse me. Let's go to crude oil, number 4. We're not even podium time yet. Here's your crude oil. Again, another ugly day. It's been just bouncing all over the place. I thought we would close this gap on crude oil. Not yet. 4.5% slide, dropping $1.56 a barrel to $32.80. Yes, producers in Texas aren't going to be able to make any money under $37, so this is bad news for anybody in Texas. That was number 4. Number 3 brings us to gold, which you would think would be soaring today on these drops. It did not. Down 1.34%, $22 drop, coming off that $1,700 handle, which we were targeting a while back. That brought it down to $1,638, but that's your bronze medal winner. Bitcoin takes the silver medal. Right now you're at 7,855 on Bitcoin. That's a slide of 2.15%. All right, final one out there as I try to rush through all of these is that 10-year, the ZN. Now the yield today spiking a little bit. Remember, we were at 150 a couple days ago. Another 9.6% move to the upside, bringing that 10-year Treasury yield to 0.82. As you can see, the candle today reflecting that with a downside move in the futures, 10-year Treasury note futures product. So that's your top 7 markets out there. A very quick market update. Hopefully you made some green on your screen today. Okay. Now, I'm going to start doing something a little bit different. As I bring on these guests who you may have met on Power Trading Radio show in the past, I want to do something a little bit different. Once we start to get a greater library of guests on the program, I will archive these and I will start to build a page on Trader Merlin where you can now go through and see the basics of these instructors, these great traders out there. So our guest who is going to be joining us today is hailing from the great state of Florida. I have to say the great state of Florida, a little bit of caution out there. We have Brandon Wendell joining us. Brandon, how are you doing today?
I'm doing just great. Thanks for having me on here again.
A pleasure. You and your bow tie, I love it. Brandon has always been a high fashion guy. I know he's a 76ers fan, but I'm liking the bow tie. It's pretty nice.
Thanks. Yeah. I shed the tank top I was wearing a little bit earlier. I was wearing the Embiid jersey, and it's spring break down here, so I was walking the dogs on the boardwalk and hanging out. Just enjoying the sunshine.
The life of a trader. Let's do this for our viewers, just so we can start to gain an understanding of who Brandon you are. Brandon and I met back on the trading floor in Southern California in 1998, and we're going way back. And of course, we're nowhere near 1998 now. Tell our viewers a little bit about your style, maybe a brief about how you got into trading, and definitely want to know about your style and what type of things you're looking for when you're analyzing these markets.
Well, I actually started off in the markets as a retail stockbroker. So you guys used to see the movie Wolf of Wall Street and Boiler Room. It's kind of what I lived. I was a penny pusher. I always joke. I say we didn't have any Quaaludes. We had a lot less Coke. But oh wait, that's on Mike.
It's okay. It's my show now.
I'm kidding. Anyway, no, I mean it was a penny pusher stuff. I hated it, honestly. I didn't feel right doing those kinds of things to people, and I wanted to help people, not just take their money. So I ended up moving into what they call the back office operations, and I was a trader for the brokerage. They call it a agency desk operator.
Yep.
So when the orders would come in from the customers, I was the one who was getting the orders filled through the market makers. And it was kind of fun for a little bit, but then I got hired at a hedge fund, believe it or not, and I went to these guys and said, this is a great opportunity. I was 24 years old. The problem was I had no idea how to trade. So believe it or not, the hedge fund sent me to Online Trading Academy, and that's where I met you at the floor. Believe it or not, it was actually 1999, not 98. I realized I graduated. I have my certificate still. It's
it was
March
so
5th,
long
1999. Yeah, I know. We keep forgetting, but it was 1999, and started trading for the fund. After about a year, I left the fund and started trading for myself, and I've been doing that ever since. So got a little more education beyond Online Trading Academy. I have what's called the Chartered Market Technician designation. I'm kind of proud of that. Basically, I've got a master's degree in technical analysis, and it allows me to do some more in-depth analysis on the markets.
Yeah, there's only for those who don't know, a CMT, Chartered Market Technician, is a pretty prestigious designation. There are far fewer individuals around the world that have a CMT designation than those that have a PhD designation. And of course, a lot of people are scrambling to get a PhD. In the finance and trading and investing world, the CMT is a much more what would we say, desirable trait to have. Certainly gives you a greater understanding of how these markets operate and how to analyze them from a technical perspective. So Brandon, you went through the class as I did. Of course, we all know back then that was really a day trading focus. You do things very differently now. I'm certainly you've taken elements of that. What would you classify your trading style as? Are you an intraday trader, a day trader, swing trader, position, or all of the above?
Yes. I do a little bit of everything. Obviously, I day trade for income, but I also do longer-term types of analysis for my wealth building as well. And I trade pretty much every asset. I don't really hold stocks. I do options rather than doing the stocks myself. The reason why is because I like to leverage my money. Instead of just going out and purchasing stock at a leverage of 2 to 1 max overnight, I can get much higher rates of return using less capital and using less time. So I usually day trade the futures market. I do what's called swing trading, where I hold a little bit longer on both the forex and in options as well. But then some of my longer term stuff is definitely in the forex markets because I get a lot of carry trade opportunities. And one of the main things I also look at doing is protecting my capital. So I do a lot of hedging when it comes to my positions and practicing putting on hedge positions with forex and futures, as well as using options to hedge my position. So I don't want to get hurt if the markets turn down like they do. I want to make profits.
Sure. Yeah. So for the viewer, I know we have a pretty diversified group of people watching right now. I know we have some that are very experienced and can hang on every word that Brandon was just saying right there. For some of you who are new, starting out, don't feel intimidated by any of that talk track. Brandon and I have some parallel tracks there. Brandon actually went and started working for a hedge fund. I didn't. I actually was working for a financial advisor, a financial planning firm. So I wanted to learn more about that industry, but I certainly don't do that now. I would agree with Brandon. I'm more of I'm a day trader, I'm a swing trader, I'm actually a position trader as well. It's whatever the markets dictate at that moment in time, and I have different accounts set up for that. So what you'll find as we introduce you to more traders in the show is some people really don't have the spread or diversity of trading that Brandon and I do. You'll have somebody like a Craig Weil who's saying, I'm just day trading and that is it. And I wanted you guys to know that each one of us has a different style and way that we use these different tactics and strategies. So that said, let's go... We'll move away from the profile here. I guess you kind of covered it. You're into pretty much all asset classes and all trading styles. So you guys can follow Brandon actually on Twitter at TraderBDub. That's Trader letter B and then DUB after it. I'll show you that here in just a second. Let's jump over and look at some markets. Now you on your Twitter feed posted some stuff, and I thought maybe it'd be nice to talk about it, just to get an understanding for some viewers of what you're looking at, because this is a little bit different than what some of our graduates may be looking at. Those are Online Trading Academy graduates. Let's start off with your S&P, which you posted this morning. Of course, you guys can see his handle on the screen, which is at TraderBDub. If you want to add him on Twitter, he generally goes out and posts a couple of charts a day with some good analysis, which I am a big fan of. Brandon, on the screen, I've got the S&P on a daily here. What do you want to walk our listeners through?
Well, basically, one of the things I'm looking at is we're dealing with trying to find targets on the downside that we might be able to hit. And the problem is we haven't been this low in many, many years. So one of the things I've been using is the Fibonacci extensions. They're not going to be quite as strong as physical supply and demand that you see on your chart. And I do mark off several of those as well. But what I'm looking at is what we call a Fibonacci projection or extension, depending on the platform you're using. What you're seeing is that the dotted line heading down is connected to the very top of the move of the market, and then what where the zero is at the very top, that upward dotted line is called our correction, and now we're in the continuation of that of the move to the downside. So what it does is basically I'm measuring that entire impulsive move from the high down to the low that happened at the end of February, beginning of March, and then extending that down from the top of the high on the, I think it was March 3rd there. And by doing that, you get these projections. You see the 61.8% is where we started stalling out, and then you got the 100%, which is a duplication of the prior move, and then there's some more targets on the downside there. Now, these are not where I'm expecting markets to bounce, but rather where I'm expecting corrections to occur in the downward move to be able to lock in some profits on the downward, on the shorts. Sorry, go ahead.
No, and I don't want to interject too much here, but I think it's important to understand for the viewers out at home, what I don't want you to do is I don't want you to look at this and say, wow, Brandon's using these projections as absolute targets. These are ideas for targets, and correct me if I'm wrong, I don't want to put words in your mouth, Brandon, but I think that what you would probably agree with is by themselves, they're not that critical, but if they line up with an area that you feel may have a strong area of demand in the past, then they become much more significant. Would that be correct?
That would be absolutely correct. Yeah, I don't want to trade on them alone by themselves, but they can be a guide to help me figure out, okay, we might have a whole bunch of areas of demand below that we found in the past, and if I get correlation where these happen to line up with one of those levels of demand, it obviously leads more, lends more credibility to that particular area and makes it a little bit stronger for me in that case.
All right, so we've got a different tool here. Now, as some people don't use fibs, it's funny because I don't usually use extensions or projections as Brandon's using here. I'm more of a retracement guy. I love the retracements. But let me ask you and play devil's advocate on this one. I see that you've got this, projection to the downside. Brandon, it's going to bounce. This market's this is it. This is the bottom. We're at 20% down. We've got to bounce from here. Why aren't you using, extensions to the upside? Why? I don't like this negative sentiment you're giving me. I'm being sarcastic, folks.
I know. One of the things, I know. One of the things that I'm also looking at, if you notice, it was actually pointed out to me, I think Daniel or somebody who was in my Twitter pointed out to me, I missed, is something called a divergence. If you notice, the RSI, the Relative Strength Index at the bottom right there, is showing that green on end of February and then also a low right before March 9th there. And if you notice, the lows are a little bit higher. Okay, now that indicator is a momentum indicator. And what it does is it tells us that the bearish momentum is dying off. So in this case, we're extremely bearish. However, there is going to be a bit of a bounce because what's happened is the prices have made fresh lows on lower momentum. They're basically less momentum, I should say. And that is usually indicative of some sort of a correction coming very, very soon. I expect us to, and we may have already done it with that one green candle on the 9th that you're seeing there, but I believe that there may be some sideways price action until we get our footing once again and continue to push downwards. I don't think this is over yet. I tweeted out just a little while ago on the monthly charts what I'm looking for a potential reversal of the bullish trend that we've been experiencing for the past 10 plus years. But I do believe we will get some sort of upward correction, but I don't think we're done with the downward move. I think we have a lot of ways to go yet, unfortunately. Or fortunately.
Yeah, I was just gonna say, bite your tongue, my friend. I think unfortunately would be bad. If you said unfortunately, I think you would basically say you're not a trader, because you know that the fear side of this is so much better, and we could see this thing absolutely plummet. And I agree with you. I don't think that we're done. When we looked at that number I was throwing out to the viewers earlier, which is 2717, that's my exact number off of the highs on this S&P. And if you go back to Brandon's charts here real quick, TJ, show that one again. You notice that he's got this area of like kind of consolidation. Do you think that that has to do with just the overall market sentiment, or do you look at things like that 20% off the market as kind of being a psychological floor for the markets?
I don't think it's a psychological floor. I know it's something that everybody's watching for because they want to see what's going on when the markets hit that level. And, everybody starts panicking. They say, oh, we're definitely in a bearish market. And again, in the monthly chart with the RSI, we don't have confirmation yet. We definitely have warning signs of weakness, but we don't necessarily have an actual confirmation. Actually, I'm wondering if I can do this. I don't know if it'll show you if I was trying to show a screen, but I don't know if that'll work on yours. Your setup.
It'll make everything work. We can do everything here. TJ's going to bring that up. Okay, now just keep it clean over there.
No, of course I am. Of course I am. I was trying to share a screen with you real quick here.
Yeah, go for it. So right now it's weird.
I'm
actually watching. You guys are watching a stream of the stream. That is kind of weird. So share something else other than the YouTube feed on there.
Oh wait, no, I got the wrong page. That's why.
Yeah, you got the wrong page.
I got to do the other page here. Hang on a second. We'll do.
Thank goodness he had that PG-13, folks, because I know Brandon pretty well, and
there we go.
We might have been fearful of what was being on there.
No. I'm not going to do anything bad.
There
we
go.
Let's do this one. This is the one I was looking for right here.
Ooh, I love it. I feel like I'm in an XLT session right now. This is great. Have at it, Brandon. Our viewers love it.
So what I'm looking at right now, there we go. So, you got to love technology. Let me move the Skype picture out of the way. There we go. So what I've got going on right there is the monthly chart. And if you take a look back, first of all, if you go back to the monthly chart here in 2008, let me just go ahead and set this up a little bit better here. And there we go. Yep. What you notice is, let me change my cursor a moment too, that we had a negative divergence, which means here you have the prices moving to higher highs, but the indicators moving to lower highs. And then what happened was we got confirmation. The confirmation came where prices failed to rally above 60 right here. Mm-hmm. And what they did then is break below 40, and that's indicative of a bear market. So if you were looking at this in real time, I need to fix this a little bit. Hang on a second here. Gotta love technology, all this cool stuff we can do here.
It is good. Real quick, how significant, or what part of your trading would you say are these divergences? Because there's so many things to look at, and I certainly don't want to convolute anybody out there's ideas or strategies. But Brandon, I know, uses a lot of positive and negative divergences of things like RSI. You can see them in stochastics. You can see them in MACDs. These are little subtle hints that behind the scenes, the underlying strength or weakness of a move is either validated or not validated. And I think it does carry some merit. But what percentage, how heavy of an influence is it for your trading?
Oh, it's extremely heavy. I mean, the thing is that this has not really failed me in all my trading. I can use this on the long time frame like we're looking at here. I can use it on the smaller time frame as well. And so you see the divergence. Now, that alone isn't going to tell you your trend's reversing. It could just be a correction.
Right.
But when we had this rally back up and we failed to go above 60, that was pretty much a death knell for the markets. And we're talking about mid-2008. As a matter of fact, I think, let's see, where was it? Right here. I'm going to bring back a blast from the past, but I think it was right here. Merlin Rothfeld was kicked off of CNBC for saying, break out the bulldozers, we're going down in a big way.
It was that day, and it's actually at the bottom of that candle, you're on right now, that was 1256 on the S&P 500, which if you take at that point in time, the all-time high for the S&P was, I believe, was 1576. You take 80% of that, that was 1256, which is that line right there, which bounced twice, and we've talked about that over the past couple of days. But thanks for the plug there, Brendan. That was pretty happy.
Yeah, no problem. And then I was on in March. I was on a little bit later, and I said, yes, the U.S. is going into recession. The reason why is I saw this. We were failing to get above 60, and that's my sign we're going into the bear market. So slide this forward to current price. And what we got going on is a very similar picture, but not confirmation. You see, back in 2018, we had the negative divergence that led to a correction, but we never went below 40. And then the follow-up here, this new high that we made on the right-hand side, right about there, we did go above 60. So that confirmed that the bull trend was not over. Okay, so now critical going forward, here we have another divergence. Let me just clean up the chart here. This will take a moment.
Is art class 1, and by the way, if you guys like art, Brandon also is a very good artist, and he's selling some of his art. If you go to at TraderBDub on Twitter, you can probably see some of his stuff there. Some pretty nice work, I might say. I never pegged you to be a great artist, but damn, you impress me every day, Brandon.
Well, I got to say, the wife is actually the better artist than I am. She got me inspired, so I started doing it again. But yeah, I've set up a a web page, and I'm actually selling it now. So it's all available on my Twitter there. But getting back to the markets too, and yeah, please support a starving artist.
No, actually, I can't
really say I'm a starving artist.
I'm waving to TJ to see if we can end this interview with you so I can get your wife on the program. But we'll have to do that another time.
She's watching right now, I'm sure.
I'm sure.
Anyway, so right now you can see there's negative divergence once again. Right. So what we need to tell us we're actually going into a bear market, not just a large correction, is the RSI either needs to drop below 40 or, excuse me, sorry, I swallowed wrong.
Hey, when that happens. Hey, don't be. You got the coronavirus. That's why we're doing YouTube interviews now. We don't want right. coming over here. All right, so basically what you're looking for as confirmation for this would be that line at the bottom, that RSI dropping below 40, right?
Right, either dropping below 40 or we get another rally in price like this, and on the rally the RSI fails to go up above 60. Okay. So if that happens, it would be the same thing we saw in 2008, and that would be the death knell, so to speak, for the S&P, and it would turn us into a bear market, and we get a much bigger move to the downside. So as far as downside projections here, if we're looking at the monthly chart and where the big picture could take us, I wouldn't be surprised to see us right around. I'll show you where it is here. We've got a strong area of demand, but it is pretty far back at about 1400, 1450 area there.
And, it's funny because I think right now if you were to tell people that you think these markets might get down to 1400 on the they'd be going, are you crazy? Put the pipe down, dude. But it's not that far out of reach. I mean, especially when you look back at what happened in 2008 where we went from 1576 all the way down to 666, guys. That was a monstrous decline in the value. Well, we were up at 3397. We'll call it 3400 on the S&P. So dropping by 50%, as inconceivable as it may seem because the rally we've had since 2009, from a market's perspective, it's really not that major. I know it seems crazy to say that, but
we've had 57% from the 2008 crash. Yeah. We had about 51% from the 2000 tech bubble. So no, that's really in line with the bear market.
I was going to go into the Russell 2000. I want to make sure we get through the half hour. So I'm actually going to skip the Russell, and I'm going to go to the Euro because you have that one on the screen here. And TJ, if you wouldn't mind, bring up that Euro chart. I think it's the next one here, just so we can get a little bit of diversity. Obviously, one of the things that is going to be a driver for this market is the value of the dollar. As you can see here, the Euro, which most people point at the European Union and go, my God, they've got a lot of problems. Well, let's be honest. We've all got some problems out there. The dollar has been plummeting over the past couple of weeks. As you can see, the euro skyrocketing from below 108 to almost 113 on this chart. Walk us through a little bit of the analysis here. And of course, this is a couple days old, so I'll bring you guys to a live chart in a second. But I want to see the analysis, what Brandon was thinking as he was kind of drawing these levels in here, and what's his thoughts on the euro USD.
Yeah, basically what happened was, obviously, as you saw there, the euro was climbing dramatically as the U.S. dollar was dropping dramatically, which is a bit unusual. You would think that the dollar would actually start to rally with the purchase of U.S. Treasuries in, kind of the risk off, as you were saying earlier. By the way, the song you were quoting was "Dirty Laundry" by Glenn Fry.
There it is.
Kick 'em when they're up, kick 'em when they're down.
I couldn't remember Glenn Fry. I remember kick 'em when they're up, kick 'em when. All right.
Yeah, that's the one. Now, at bonus points, if you remember what movie it was in.
Oh,
I'm sure Nicole Kidman.
I'm sure it was more than one movie, but apparently
the big feature one was with Nicole Kidman. Okay. So we'll see if you can remember that movie. Anyway.
Please. If it's not Star Wars, I don't know what the hell it is.
I think who was in it too? Matt, I can't remember his name. Matt Dillon, I think it was.
Oh, Dillon.
She hired him to kill her husband.
I don't know.
In the movie. Anyway.
You're going back on me. Yeah. All right.
Anyway, getting back to this, what was I thinking at this time? I was thinking we were coming into an area of supply. That 115.34 was that area of supply that we were going to be coming into. Yep. And that was on I believe, the daily chart. And like I said, what goes up usually comes down. So I was expecting it to push back to the downside with a possible purchase in the U.S. Treasuries, and I didn't actually follow up to see how that turned out.
That's why I wanted to bring it up, because it's not one of those ones where you just, I'm not trying to go, look, you were wrong, but it's actually a learning lesson, because if you guys look here, there's that 1534 mark, and here's where we start to learn different things about different people. I am a huge fan of whole number psychology. So as I'm analyzing that one, as I saw that tweet from Brandon on Trader B Dub on Twitter, I was thinking, boy, if it was me, I probably would have looked to go at that 115 even, because it's the whole number. You were looking at 34 pips above that one, which I like the zone better. But when a situation like this happens, you had that dollar sell off aggressively. And I know that this pullback is what you were looking for, but it didn't quite get up to that 1534 that you had marked. How do How do you handle this one? Do you end up like modifying your zones or move it down, or you just say whatever, I'll move on to the next trade?
That's a nice thing. You miss the bus, you just catch the next one. It's not a big deal. So yeah, what we experienced was a run to that upside. And one of the things I want to point out on that chart, first of all, was the candle to the upside, that last green candle. It's what's called an expanded range candle, and that's usually indicative of novices chasing price. So usually when you see something like that, it's just a large candle in the same direction you were already traveling. It's usually the end of the move.
Yeah.
So when that candle was formed, like you said, it ended up right at the whole number. And I'll give credit to you and also to David Warner. I don't know if you had him on at all, but David Warner, one of our fellow instructors. Anyway, he's also a big believer of the whole quarters and halves, and they work when it comes to money. When you think about money, that's what you think about. So the 115 whole number was definitely a psychological barrier for price and proved to be a better zone than what I was looking at, which was the actual zone. Hey, c'est la vie. That's just the way it goes sometimes, right?
Yeah, absolutely.
What happened was there was actually there really wasn't another area I could have identified there. Unfortunately, it was it. So if I missed the train, I missed the train. Now, what's going to happen in this case? It looks as though we're simply getting a retracement. And what's happening in that retracement is we're getting a pullback. So here's your Fibonacci retracements again this time. Actually, if you want, real quick, I can do that share screen again. Hold on, I did the wrong one, didn't I? Hang on, let me do the right one here.
I can throw it on there for you. The
retracements
you're looking. It's funny because the 50% retracement is right into an area that I'd be looking to buy. There's 111.35.
Yeah, what I'm looking at right now, let me just turn this off and get it set up correctly here. See where I'm at for the Fibonacci extension. And you're talking about 50%. I have a 111.70 as my area of demand there anyway, so that pretty much lines up. Like you were saying before, you don't use the Fibonacci's by themselves. You use them to help confirm other things you're seeing in your chart. And what I'm seeing right now, if I lay a Fibonacci extension or retracement here from the move up, it lines up with that area of demand around that 111.70 to 110.94, basically the whole number 111. The 50% retracement is actually 111.36.
Right in the middle of the zone.
Yep, that's your 50% right there.
So, these are one of those things where if you're looking to jump into this rally and participate in that move to the upside, that might be a solid place. Of course, I don't want anybody to take the numbers that Brendan's showing or I'm showing. You got to do your own homework here, but make sure you wrap a plan around it. So if you're looking to buy at that 111.36 or whatever, make sure that you have some rules set, a plan in place, a stop loss, of course, because as we've seen, the volatility in this current market situation has been off the charts and totally bonkers nuts. Let's go to one last listener question here. Normally I was going to wrap up right there, but I wanted to give the opportunity for us to do analysis on gold. This is an interesting one because I know that you're a practitioner of relationships. Let me make sure I get the question here. Patrick on Trader Merlin's YouTube channel says, if there's time, thoughts on today's gold sell-off concurrently with equities? Normally there's an inverse relationship, the risk-on, risk-off type of thing. Well, today we saw a situation where equity markets got hammered and gold also got hammered. Do you think that this is a kind of a one-off event and we're going to start to go back to the normal, or what's your take on that convergence of those two assets?
Well, I got to say that what happens with the markets is that everything is cyclical. There are cycles that we go through, and the first cycle is the bond market's peak and then the drop. If you were to take a look at the chart of the ZB, the 30-year Treasury, on a monthly basis, going all the way back to 2005, from 2005 to 2008, it did a nice W pattern, and we did the exact same pattern. So we've just completed the last portion of this before the what should be a recession in the U.S. So every recession that we have in the U.S. is followed by these cycles that typically happen. The first cycle is the bond market peaks, usually about 3 years before the recession hits. So we had a bond market peak in 2005, and then we had obviously the recession announced in 2008. Well, going forward, we had a bond peak in 2016. Obviously, we're at some new highs now in the yield, or lows in the yields, highs in price.
Right.
The second market to cycle is the stock market, and that stock market usually cycles following the bonds, because a lot of people think bonds and stocks are opposite of each other. They're really not. They're offset from each other. So when you look at the stock market, that generally peaks about 24 to 27 months before the recession hits. Now you might be saying, wait a minute, Brandon, we just had a peak in the stock market. Yes and no. Yes, we did in the S&P, we did in the NASDAQ and the Dow, but we did not in the Russell. The Russell actually peaked in 2018, which would put us on track for the recession this year. Now, the third cycle is commodities, and the commodities last time peaked in July of 2008. And then they announced the recession in November that same year, but they were already in the recession. So gold to have run and spiked is really right on time with the cycle that we should be expecting in these markets to announce a recession maybe later this year. So everything's happening in the same cycle it did in the last several recessions. We had 2000 with the tech bubble, also in 91, we had the recession during the Gulf War, and the current recession, which I believe we are going to go into a recession in the U.S. And people blame it on coronavirus. You can blame it on whatever you want. But the point is, it was going to happen anyway, and now we just have an excuse that they can talk about on television, I think.
Exactly. They can point the finger at it and be like, it was the recession, it was coronavirus. I love when that happens, when we find a victim for it. But it was very timely, and it's certainly interesting. I don't know if you guys read that. I actually just got this tweet today. Actually, it was a message sent to me from a friend of mine. Kind of crazy. We talk about the coronavirus freaking out people and them shutting down centers. I don't know if are you a basketball fan, Brandon?
Oh, absolutely.
What about college?
I know they're shutting down March Madness, man.
March Madness. Get this, folks. I don't know if you read this, but the NCAA just announced that all games for the NCAA tournament and upcoming tournaments will be played on TV only, no fans present. So those crazy buzzer beaters, the last second, there'll be like nobody clapping. I don't know. It seems absolutely nuts to me. But this just further exacerbates the probability of going into recession. I agree with Brandon. I think we are going to see a recession here soon. I actually think it could get much worse, because of the incredible amount of layoffs that are going to happen in a very, very short period of time because of the cruise liners, because of the airlines, because of movie theaters, malls, all that stuff will create a cyclical, really quick downward pattern. Not to be a purveyor of doom and gloom, but save your cash. Don't go out and buy a bunch of new stuff right now. Keep that cash so when this market does drop 20, 30, 40, 50, maybe even more %, you can buy back in and do well on the market rebound, which will happen at some point.
This is an opportunity, yeah. And by the way, if you want to go on a cruise, we can buy 1 week, you get 2 free.
Do you really? You're doing cruises all the time.
Well, you get quarantine after the first week. You know that.
I didn't get the joke, but I'm dumb. Thanks, folks. It's here all day. All right, Brendan, so let me guess. The easiest way for people to get in touch with you is to go to Twitter. It's at TraderBdub, correct?
That is correct.
Awesome. Brendan, thanks so much for coming on today. I have the feeling you'll probably be on much more. Our viewers love the format. They like the announcements. They like that. They even love the bow tie. You're getting nice compliments on your bow tie out there. So
and it's a real one. Wait. You got to see. It's actually a real bow tie. I tied it.
It's great. So you guys ever take a class with him? I think he actually had a student who was giving him a hard time about his clip-on tie. And he's like, hold on a second. Undoes it and then ties it. It's an art to do that, I will tell you. Well, maybe one day we'll have a class on how to do a bow tie. Anyway, thanks so much, Brendan. I appreciate it. All the best to you in your trading. Look forward to having you back on the program soon.
Thanks again, Merlin. You have a good one. And I am tying it right now in front of everybody just so you know I can do it.
You did a damn good job. I think most people right now, that's probably the most viewed part of the program is going to be watching Brandon retie a bow tie.
No mirror either.
We'll just clip out that little segment. It'll be the most watched piece we've ever done on Power Trading Radio. All right, Brandon, thanks so much. We'll see you next time.
All right, thanks, Merlin.
Guys, that was Brendan Wendell, a longtime friend of mine from way, way back in the trading floors, and of course, an instructor online trading academy, gone on to do a bunch of other great things. You guys can see some of his tweets and updates by going to Twitter. It's at TraderBdub. Of course, we'll be doing much more with Brandon in the coming months. That is kind of it for today's show. I think I'm hoping you guys all kind of like that. You guys all seem to be doing pretty good. Yeah, everybody like that one? All right, cool. If you like today's show, as I hope that you did, and the new format is definitely a little different, I would encourage you to click that little thumbs up button there if you're on our YouTube channels. Certainly encourage your friends or yourselves to subscribe to the YouTube channel. That's probably the best thing that you can do for me, or subscribe to the iTunes podcast. Spread the word about it. We certainly want to get more great guests like Brandon on the program, more great content that will help you guys maybe understand these markets a little bit better, maybe a little bit more prepared for any sort of market correction. It's funny, I was actually messaging with a friend of mine who has been asking me for a while, what should I do with my money in these markets? I said, in your 401k? She says, yes. I said, go to cash. Just get out. And she's like, well, the last time this happened, I just held on and it all came back and everything was fine. I'm like, yeah, but you wrote it out for 8 or 9 years where your money did literally nothing for you and then came back to break even. That's wasted time. And she's like, well, what would you do? I said, go to cash. I go, would you rather lose another 30 or 40% in your account if it drops that far? Go to cash, buy back in at a point much lower. And I think that for myself and most of my trader friends, we're all in agreement that there is probably a bigger move to the downside coming. I think it will come when we get the S&P closing below that 2717 mark and we finally see an official bear market on the S&P. But that hasn't happened yet. We haven't gotten a close below 2717. My guess is you'll probably have a bounce. Next week, we know the Fed's going to cut rates. That will probably pop the market a little bit, give us a great opportunity to go short. It'll come back down maybe in a week or 2 or 3 and retest that 2717 mark, maybe bounce again. My guess is we'll get 1 or 2 bounces off it. But once we start to close below it, It's going back to my interview on CNBC in 2008, which is break out the bulldozers. We're probably going down in a big way and much faster than last time, because last time the Fed could bail out the banks and stop the bleeding. In this situation, we're dealing with this wild card unknown, which is the coronavirus, which I and most of you probably believe is completely blown out of proportion. It doesn't matter. It just goes to the stupidity of the mass population falling for media influence. You know, good example of why these markets will probably continue to have panic selling and people freaking out is the same reason people are running to Costco and your local stores hoarding toilet paper. Because again, I like to mock them, because really, what's going to happen? Do you think this is going to make you go to the bathroom 20 times faster than normal? It's a cold, folks. Buy tissue paper to blow your nose maybe, but no need to freak out. It's the herd mentality that's driving this frenzy for toilet paper. It's also the herd mentality that's driving the sell-off for the equity market. So wait till we get below that 20% mark on the S&P. When that happens, might be a good opportunity to be going short. I mentioned, and some of you viewers have asked, do I think the S&P will get back up to that 3,000 mark? I sure hope so. I really, really, really hope so. Why? Because that would give me an opportunity to go short with pretty much everything I got. I'll be shorting quite a bit at that position. It just hasn't happened. I've been waiting for a nice bounce. I thought we'd get like a 2 or 3 day rally so I could go short. Anyway, long overdue for the show. We've gotten way past our time slot, probably the longest show so far, and I've tried to keep this thing at 30 minutes. So that will do it for today's show, everybody. Thank you guys for joining us again. Please click the subscribe button, thumbs up, share with your family and friends, leave some comments and questions. If you want to know more about any of the other media programs we have, such as Twitter, Instagram, Facebook, and YouTube, go to TraderMerlin.com. Until then, happy trading, everybody. We'll see you tomorrow. Take care.
The Trader Merlin Show is produced by Merlin Rothfeld, Gary Christmas, and TJ Writings. The show is engineered and edited by TJ Writings. For more information, visit TraderMerlin.com.